Aloha! Hey, it's Julie Zimlos, 365 Hawaii with Real Broker, and today I'm with Travis Green with
Guild Mortgage.
That's right, and he is on fire today. He's got some great information for you guys. We're be talking about rates. We're going to be talking about doing the math on investments, and he's going to give you a real life example to talk about why we're talking about passive income in Kona. And I'm also going to give you a little bit of information about what's happening right now with the housing market. It's ever changing, but we will discuss that. So why don't we start with Travis giving us information about the money.
The money, yeah, a little money update. So, so since our last video, rates have staged a pretty good rally, I would say. Main reasons for that are a couple things. Inflation continues to cool and appears to be on a trajectory to the Federal Reserve's target, which is 2% per year PCE inflation, personal consumption expenditures. So that seems to be on track. So the Federal Reserve is shifting its focus to labor and employment. And so because the Fed has that dual mandate, right? The dual mandate is achieve price stability, which is inflation, and maximum employment, which is the unemployment rate. And so the big thing lately has been that the unemployment rate has ticked up, and jobless claims have increased, and so that has kind of like spooked the markets a little bit, and so that it seems like the unemployment rate is kind of ticking up a little bit while inflation is like going down slower or gradually, and so we might be achieving the fabled soft landing. The elusive.
Is that what you're hearing?
Yeah. I mean, it's we probably won't know until hindsight if we achieved a soft landing. But it kind of like recessions are determined like after the fact. Right.
When they can see the two quarters in a row were like lower than they thought or something. What's the? That's like two. They have to prove that.
That's kind of like a rule of thumb. The two consecutive quarters of like negative GDP. I forget. There's kind of like a quasi governmental body that like actually determines these things. It's like a bunch of nerds that look at very like certain economic
indicators
data
in the market,
and they go, oh well, this period the U.S. economy is in a recession, but it looks like a soft landing, and. Importantly for that is that the Federal Reserve is expected to probably issue a rate cut in September. That's baked into the mortgage numbers that are out now. Right.
I heard that the mortgage rates went down in anticipation for them lowering the rates, right?
Yeah, and not just that, but because the consensus has been probably a September rate cut for a while. But it was the Fed Funds futures market, which is it's a market where investors place billions of dollars in bets on what the Fed is going to do in the future. So this is money, people speaking with their money. The Fed Funds futures market is now predicting maybe a total of 4 rate cuts of a quarter point by the end of the year.
Of this year?
Yeah.
Oh, good.
And so that number is shifting around a little bit, but that's what's really kind of, I think, pushing mortgage rates a little bit lower is not just the approaching September meeting, but the likelihood now that that's not going to be the only one, and we might not just get 1 or 2, we might get 3 or 4. Which
would bring us down to?
It would make the effective Fed funds rate about 4.3. It'd be like 4.25 to 4.5, because right now it's 5.25 to 5.5.
Right. So the consumer then would probably get, usually it's a point above what that is.
So that's a short-term rate.
Yeah.
That's the rate that banks charge one another for overnight lending. But what it does is it has influence on the 10-year Treasury yield.
Okay.
And so
this is the part where it's like,
so it feeds into a system that trickles out, right? And has other knock-on effects. But the 10-year Treasury rate has more of a kind of a correlation with the 30-year mortgage rate, the average 30-year mortgage rate. And so when the 10-year Treasury goes up, 30-year fixed-rate mortgage rates tend to go up. And likewise, when it goes down, they tend to go down. And then there's the spread between what the 10-year Treasury rate is and what the average 30-year fixed rate is kind of changes over time. Historically, it's like 1.7, 1.8 points. So a 10-year Treasury of 4% would typically yield an average 30-year fixed rate of 5.7, 5.8, something like that.
2 points, okay.
But right now, the 10-year Treasury is like 3.9, and the average mortgage rate, drum roll, is about 6.6 today.
Okay.
So we're like, what is that, 2.7? So there's like a full percentage of extra spread, and that's risk. That represents risk,
okay,
and uncertainty. And so if the 10-year Treasury doesn't have to do all that much over time, but if that margin can compress, you'll see mortgage rates come down.
Okay.
So if there could be less
the big thing is
uncertainty.
here, is it going to get to the 5.9 point?
Yeah. I could. So
I'm like, just give me the news.
Yeah, give me the good stuff. So here's some mortgage porn for you. I closed 2 loans this month with an interest rate that started with a 5.
Ooh.
And the way we did it was we were able to negotiate some stuff. The buyer and the very capable buyer's agents were able to negotiate some seller concessions.
Oh.
And these buyers happened to be considering a lock around the time that rates were dipping, and they maximized their concessions and said, look, I'm going to keep my cash to close about the same. What can we buy my rate down to and keep that about the same? And in this case, it turned out to be 5.875. And so these were people who, when they applied for a loan, we were probably talking 6.9%, 7.25, something like in that range, and they're closing under 6%. That's with seller credit. But even a couple months ago, rates like that on a conventional loan were effectively unattainable.
Yeah,
they would have cost 4, 5, 6 points, just an incredible amount of money, and now maybe a couple points.
Yeah.
You know,
so if
to
you
get
can
down
get
there.
somebody to give you, like, say, $20,000 in seller's concessions towards your mortgage, would that be enough to do anything?
Yeah, I mean, especially depending on the loan amount.
Okay.
So when we talk like a discount point, like if somebody pays a point to buy it down, it's 1% of the loan amount.
Okay.
So $20,000 on a $500,000 loan goes a lot further than $20,000 on like $1 million loan.
Right. Okay. Because these guys that we're talking to right now, if we're talking about the kind of inventory that we're talking about, single family homes with passive income are still going for probably 1.3, 1.4, 1.5.
Yep.
Right. So.
Or $1 million, something like that.
Yeah. So. And just in there, we're always thinking about ways to give you guys maybe like little tips that you guys can figure this out, because there is a softening in the market.
Yeah.
Even though we just did the housing stats a couple days ago, home sales have surged 46%. So people are still trying to buy something. However, I don't see multiple offers, and I still see people making price reductions.
Yes.
So I still think that there's opportunity in the market. In fact, there's 2 houses still on my street that are investment properties. They're still sitting there now after 200 days that are ripe for going in and saying, hey, what's it going to take? But on the opportunity to tell a seller, hey, if you give me some money back towards the seller concessions, they theoretically don't have to lower the price of the house. So there's something like a reason why not lowering the price of the house, getting a seller concession just to give you back money without lowering the price of the house is better?
For the buyer, yeah, for a buyer using a loan. And so, for instance, like, let's see. So let's say a house is listed for, let's take my personal investment property that I'm listing right now.
And we were going to go there, yes.
So let's talk about that. So we have it listed actually for $925.
Okay.
And it's a 3-2 with a studio 1 bath, unpermitted bath, but studio 1 bath downstairs. And rather than dropping our price, because I saw what was happening with rates, we are at $925 with a $20K credit to the buyer for their closing costs.
There you go.
Right? And so that's roughly 2 points.
Okay.
So so somebody can take that, and right now, if you were to take those 2 points and like throw it on your loan, you know, that $20,000, you could buy that down under 6%.
Okay, and that over the course of a 30-year for 30, 40, 30
Thousands of dollars
thousands
difference,
of dollars, right?
Yeah, that way more than $20,000,
Yeah.
right? So you're going to save way more than that over the course of the loan, you know, unless you refi in a few years or something. But
and you could if it gets down to like
it gets to
4 or 5.
Yeah, but I mean, yeah. So I don't know anybody that thinks it's going to get below 5.
Okay, I was trying to be optimistic.
I mean, we'll see. We'll see.
I had a guy, a mortgage guy, tell me there's no way we would ever see above 5%, and then 2 years later it was 8.
No way.
So I don't trust people. I'll just.
Oh my God. Yeah. Well, pour one out for that guy. He's having a tough time. He said the treasury yield spread or whatever would never get above a certain point again, and it was like 2.2%. He's like, we'll never see anything above 5 again. Just like flat out, he's like, it's just not going to ever happen again. And then boom. So. Yeah. Which is so funny because like in 2018, we were starting to see rates go up towards 5%. People, this has been memory hold, because before then was a super low interest rate time for like 5 years or 4 years, and then really 5 or 6 years, and then right after that was a super low interest rate time. But there was a time, 18, 19, we were creeping up into the upper fours and towards 5%. And I remember having like investors, like, you know, people that just buy investment condos, being like, you know, 4.8, what the hell? You know, 5.25, what is that? And I'm like, buddy.
Yeah, and let's remind the audience that the average mortgage rate across time has been about 6.5%,
7%. Yeah.
So,
yeah.
So if it gets down to 5.9, and the reason I'm asking this question is because they said, with all these people who are locked into these loans that they got for 5 and under, they most likely will not move unless they see the number 5 again in their life.
Yeah.
So I'm just saying that we could get some of this inventory out into the marketplace, because people will get out from underneath their low mortgage. Then maybe we can see some more inventory coming on the market.
Well, yeah, it makes it a lot less painful. So we were just talking about this right before we went live, is that back in October of last year, the average 30-year fixed rate mortgage topped 8%. I mean, I remember loans at like 8.25, 8.125. It was ugly stuff. Phone was not ringing a lot.
Yeah.
And I was like, what am I doing?
He learned how to swim.
Yeah, exactly. I reinvented myself. But anyway, today it's like 6.5, 6.625, something like that, you know, in that. So that's a 1.5 in that period of time, in 10 months.
Yeah.
And so, yeah, I think we're seeing it now. We have more listings right now active on the market than we have in a while. We're still, you know, we're still undersupplied. But I think that more of that will get dislodged with lower rates, because it's just painful if you have, you know, a mortgage rate that starts with a 3 on the house that you own, and you know that if you sell it and go back out into the market, you're going to have something that starts with a 7. Ugh, you know, like, it's not. Yeah.
That's why they said psychologically.
There's some heartburn with
they
that.
wanted to have the 5 something. So
and just financially, like, there's a big difference on an $800,000, $900,000 loan, $700,000 loan. Between 8% and 6.5%, or 8% and 6% or 5.5%. It's a big difference. Right. We're talking hundreds and hundreds of dollars a month. Okay,
but Kate, get this, because I asked you this when you first got in here today. In terms of activity that you're seeing in people now applying for loans, it's definitely upticking.
Yes.
Right? And we also saw a headline today that says buyers are rushing back into the market as lower rates show up. Yep. And I haven't seen a bunch of people calling me lately, but we do have a couple more buyers in our little pool of looking right now than we've had in a while. So that's good. So I don't think it's caused this like rush back into the market that much yet here in Kona. However, they did say that, because I went to this really expensive real estate conference to tell you this information, that when people say, you know, the election stops people from buying homes.
Right.
They did say that sometimes there's a pause.
People are like, what's going to happen?
Right. They don't know. So sometimes there's a pause.
Yeah.
But then they all come back after the election and start buying homes.
Right.
And then they've done like the research, like 7 out of like the last 10 election cycles, prices of homes actually go up after the election because of pent-up demand.
Right.
And then all of a sudden everyone's out there buying.
Right.
Right. And then they also said that what they did say that, you know, it just kind of goes that, yes, sometimes the mortgage rates actually go down a little bit before an election. They just said, you know, that just kind of happens. Right. So in that, I was talking to my other, you know, I do my East and West updates.
Yeah.
This is a sweet spot right now to buy a house.
Yeah.
Because there's the product is sitting on the market longer.
Yep.
Opportunities to make concessions for sellers to give you a price discount or pay down part of your mortgage.
Yes.
Right. And there's not a lot of competition out there right now.
Right. And better rates than we've had in over a year. Right. So, there's a lot of pieces that, like, if it made sense a year ago, it makes more sense now. Mm-hmm. What I've really seen the activity, like in my day-to-day workload, has been, hearing from people who I maybe pre-qualified early this year or last year, who kind of put things on hold, or like maybe missed out on some things and just decided to wait. Those people are kind of dusting off their pre-approval and going, hey, you know what? Last time we talked, it was 8%, and I've gotten a little bit of a raise since then, or my uncle left me some money, and I see that rates are lower. Can we see? I have a down payment now. Like, what does that look like? Or I have a co-signer, I have a co-borrower. My partner's willing to go in on it with me. So
I'm seeing some of that too. This like
people who's like
they really want to get here and they're making things happen.
Yeah,
and that's another reason we started this group too, is that we're giving you this opportunity to buy passive income property because you can finagle if you have an ADU and get a better, so you can actually get a loan that makes it so that you can pay it off faster with the income that you get from your house, right?
Yes.
So
yes, I've also seen people who I've worked with in the past to either buy or refi a property here, reaching out to feel out, maybe buying an investment property or maybe upgrading their house, because it's that thing is like rates are lower now and they have some equity and they're feeling a little more. They're just feeling better about maybe getting into another purchase right now. And so people that have already bought and benefited from that are thinking about keeping something and going out and trying to buy something else.
Yeah, there you go. Yeah. In fact, we know quite a few people actually who have single family homes and they own condos down in Hawaii. So, yeah.
I had a conversation yesterday just like that.
Yeah, and people do that. And then they use that as the investment condo money to come and make sure that their mortgage gets paid. So it's kind of like a little business that they're running down there.
Yes.
But I'm here to tell you guys, if you've been watching any other shows that we've been doing, the condo experience here in Kona has been shifting with the increase in HOA fees.
Yeah.
So it's over 200, 300, 400 sometimes has gone up in the last few months in terms of HOA fees for like 2-bedroom, 2 baths. So there's like 15 condos for sale in the Lihilani, and it's a glut of stuff on the market. So the prices are going down, they're not moving because, and I was talking to Travis about this, that instead of buying a condo and paying $1,100 a month in your HOA fees, what would be the sticking point for buying a house, right? And so tell them a little math on that.
Yeah, so right now, like where rates are, say 6.5%, every $100,000 that you borrow is about $620 a month, right? So in that example, like that, $1,100 a month HOA, which is not uncommon here, right? Yeah. That could be almost $200,000 in price, right? So if you're looking at a lot of condos that have an $1,100 HOA are probably in the $700,000-800,000 range, $600,000-700,000.
Yeah, the median price of a condo right now is $575.
Yeah. So if those numbers can work for you with $1,000 HOA or $1,100 HOA or whatever, which by the way is probably going to continue to just go up, they don't tend to go the other way.
True.
It's just true. Same with taxes and
taxes.
Yeah. The government's like, you know what, we're good for a while. But it's definitely worth looking into maybe like a single family home at 102 or 200. And when I'm taking an application from somebody, which I like to do over the phone, one of the reasons is I like to ask them, like, are you thinking more condo or a single family or a multifamily? Like, what are you leaning towards? So I want to hear them say, like, some people will just fill out an application to be like a condo or house.
Because that's all they think they can afford.
Right.
Or,
and then that drives the conversation because it's an assumption. But if I'm asking them on the phone, like, what are you leaning towards? And I'm like, well, I assume I have to buy a condo, but I'm open to anything. Yeah, like I would buy this or that. Or some people say, I only want a house. I will not consider a condo. But that's a question I always ask. But yeah, and then what I'll do usually is for people who are open to either, I'll give them 2 pre-approvals. One for a condo, one for a single family home, because those are going to be different amounts. Right? What you qualify for a condo is going to be different from what you qualify for a house.
Because you have to wrap in the HOA fees and all that stuff that goes with it, right?
Right, exactly.
Okay.
Right.
Okay, so speaking of that too, just a random mortgage question.
Yeah.
Is you're wrapping their HOA fees into what they have to get, you have to be able to qualify for the loan, right?
Yeah.
But you're not wrapping in that someday those guys are going to need a roof and all the stuff that happens in home ownership.
Not directly. So,
how's that work?
Yeah. So,
are you penalizing those poor little condo guys?
Most properties are going to have an appraisal, right? Okay. And so the appraiser, whether it's a single family home or a condo, the appraiser is going to talk about remaining economic life, and they're going to talk about the condition of the property to an extent, and they'll advise if there are repairs necessary for it to be like a lendable house right now. But as far as are they going to need a roof in the future, blah blah blah. No, we're also not typically looking at a condo purchase that way either, because when a condo complex needs a roof, that's a massive, 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 massive expenditure that is going to result probably in a special assessment.
Right.
Or often, I shouldn't say probably. It
will.
It can result in a special assessment if they budget for it for 22
yes,
years.
and they put it in the reserves.
Right. And that is something that we do. We do dive into the reserves on a condo. We're going to look at the reserve study. We're going to look at the recent inspections. And so we do look at that and say, okay, it looks like you guys have a roof coming up in 3 years and like not quite enough in there to pay for it with what you have budgeted in your reserves.
Yeah.
Is there going to be a special? And so we literally will dig. Like lenders will dig with the management company and say, like, how can you say that there's no plain special assessment when you're underfunding your reserves and you've already said that you have this project coming up? Like, connect the dots for us. A big reason for that is that. I forget the name of it, but that tragic condo collapse in Florida a few years ago.
Yeah, Miami.
When over 90 people died.
Yeah.
Fannie Mae and Freddie Mac got very, very serious about building maintenance and deferred maintenance and major structural issues, especially with condo projects. And so that's why it's such a fine-tooth comb and such a keen eye on things like that in condo lending. That also ties back to the reason that these HOA dues are going up so much is that, among other things, like number one, over the last 4 years, the average value of all residential real estate in the country, on average, gone up by like 40-50%, right? And so when the cost of your insurance policy corresponds to the value of the thing it insures, right?
And so the replacement cost.
Right. And so it makes sense that like across the board, all of our insurance costs are going up because we own more valuable things now.
Yeah.
But with condos particularly, and I do want to pick on Florida, if I can. Is that okay? Can I pick on Florida a little bit? So Florida, and fight me in the comments if I'm wrong about this, but let's talk about it. But Florida, specifically Miami-Dade, has this incredible mix of real estate in their real estate market. Essentially, the most salient fact is that they have the highest percentage of their real estate market as condos of any major real estate market in the country. Miami.
Yeah.
And I think over half of those are complexes that are over 50 years old.
Ooh.
And so, and obviously there's like an ocean there.
Right. Much like Honolulu.
Yeah, hurricanes, saltwater, etc. And then the other thing that's important to understand about Florida condos is that for a long time there was no, as far as I understand it, there was no statutory guideline or requirement for condo like financial reserves, right? So they weren't required to hold like a certain amount of money in reserves every year. And that's changing on January 1st of 2025.
Oh.
And so what you're seeing in Florida, because I've seen this start to crop up on the news, is that like the Florida condo market, like prices are way, way down. People are flooding the market with condos. It's because they're passing a lot of these condo projects, not all of them, but a lot of them, especially in Miami, were way, way, way underfunded. And so now they're having to pass like 6-figure special assessments in some cases.
What's happening here?
Yeah. But they're like per unit owner.
Ugh.
And so somebody that paid $400,000 for something 3 years ago there is getting hit with a $100,000 special assessment, and they're trying to sell their condo for $150,000 now. You know, so it's just the math ain't math in the Miami condo market, but also homeowners in Florida sue their insurance companies and make claims at a much higher rate per capita than anywhere else in the country.
Because of all the flooding and the wind damage. And
and alligators and cocaine. And so I think that I don't know where I'm going with this. I just think that Florida owes us all an apology.
Well, dude, okay, so when I was like working with the Association of Realtors back in the Bay Area. Okay, that's like, 15 years ago, they were talking about how Florida, every time they keep getting hit, right? FEMA or whoever has to keep doing this. So the American taxpayers footing the bills of these people's bad habits of living next to coastal areas that they ruin their housing, right? And so what the Association of Realtors was trying to do, because that's what they thought was going to happen, they said, well, if we raise all the insurance rates on those homeowners in the coastal areas, then they'll all dump their houses.
If we make it prohibitively expensive to live there.
And then, oh my God, no one wanted to make that happen.
No.
So they stopped the legislation on it.
But
so it's like it's been like a kicking down the can problem.
Yes, yeah.
And so now here we are with more hurricanes, more coastal flooding.
And it's the same thing, especially in California with wildfires, right?
Yeah.
And the WUI, they call it, the woodland urban interchange or interface, where communities are built in woodland areas, and so the drier and hotter it gets, and it's not going to get less dry and hot.
Right.
The more wildfires we're having, the more property destruction and damage, and so that's the thing too. Is like, your heart breaks for these people, but like, continuing to rebuild in those areas is just like that. That's also harming, and that's across the Mountain West.
Yeah,
that's Colorado, Utah, Oregon.
Right.
But yeah, the placement of property in areas prone to natural disaster and destruction, coupled with the rapidly rising values, that's the whole story of insurance.
Yeah, that's it's like that's exactly it. More risk, more money, more loss, more cost.
Right.
So, but I'll tell you guys, wrapping that back to what we're talking about in this group, is the fact that, and again, knock on, we have some wood. I was this woman who's creating a resilience network here on our island about making sure that we have food and everything, but making sure that we can actually withstand a bad thing that could happen, right? And so when I was thinking about all the bad things that could happen, we've been here for almost 20 years. Nothing that bad has happened.
Yeah.
So we're lucky because we don't have wildfires that are making us, because we're not in this area, especially. That's what I'm telling you guys.
We don't get smacked with hurricanes.
Right. If I could sell you a home around this area, it would be that we don't have unbridled fuel because it rains a lot here and everything's green, and we do have some wildfires out. Like they when they have too many open areas that could catch fire because of people that might be living there illegally.
Yes.
Right? And so they're actually working on that now.
Or people flicking cigs from the cars.
From the cars. But we haven't had, like, mass loss of residential structures in Kona.
Right.
Like, ever. And then also the fact is that we never get hit by hurricanes because of our mountains. They're beautiful, wonderful human things.
Right.
And even when we did get kind of that side swipe of Aniki, we didn't have like massive loss, right? And then also we have our earthquakes, and even when we got hit with a 6.7 a long time ago, it didn't cause massive problems. There were some people who had like some structural damage, but we didn't really have.
Right.
So
or the 2011 tsunami.
Right, the tsunami. Downtown was a little bit. So we have been hit by crazy things,
right?
But yet we survive, and so I think this is a very safe place to live.
And I will say the cost of homeowners insurance on single family homes reflects that. It's not that expensive compared to other markets.
Yeah.
It just isn't.
It isn't. So I think that in terms of, if you were to try and say, well, where's a good place to invest my money in real estate that's not the Wild West and not the coastal, the Carolinas and Florida and Mississippi and New Orleans.
Right, yeah.
But this is a pretty good place, right?
Yeah. So I think it's a great place. 100%. 100%. Yes.
Because you lived here. You lived here for how long?
5.5 years.
Okay, good. Yeah.
Yeah.
But I'll tell you, after 20 years, the worst thing I think that ever happened was we had the tsunami. I think the tsunami is probably the worst thing that ever happened. Yeah, 2011. And again, it didn't happen. Nothing happened up here. It was all down at Camp 3, the hotel.
Or Kelikakua.
Or Kelikakua Bay. Yeah. Don't buy right there.
Right on the water. Yeah. Just don't get too attached.
Right. So basically that's that part of it.
But the other thing about Kona that's important to understand about, we all live on this like slope. Right. And so
flooding doesn't happen.
Right. Like even when you're close to the water, you're relatively high up in elevation.
Yeah. In fact, I looked at the coastal flooding maps for the future. It's not that bad.
No,
here.
it's not.
And also we live on
sections
a porous.
Of where you drive.
Yeah, we live on a porous rock.
Right. Yeah.
We don't live near marshlands. We don't live flat areas. The whole thing's like on the stadium seating experience.
Yes.
Yeah.
It is like a stadium seating experience.
It is. And so even when we get a ton of rain, it soaks into the ground, or runs down, on Kuakini.
Yeah, exactly.
Yeah, so
or Aloha.
Yeah. So when I see the crazy flooding that's happening on the East Coast, we just don't have neighborhoods that are sitting in water. We just don't.
Well, Hilo.
Here. Well, okay, Hilo Bayfront, but look at Hilo got 50 inches of rain in one day in Hurricane Lane. Lane, that's the name of it. Yeah. And it basically dissipated in 4 days.
Yeah, Hilo's built for lots of rain.
Bad things, like tsunamis and everything. Yeah,
Hilo's built for lots of rain.
Yeah. So you were going to do the math on your thing.
Yeah. Okay. So
let's go back to this real quick.
Yeah, so passive income. So I mentioned that my wife and I have a rental property in Kona, in the Palisades neighborhood up by the airport, and we did the nomad thing. We bought it as a primary residence. We moved into it. We did some renovation, and then a little after 2 years of being there, we moved out and bought a different place as a new primary residence, and we put tenants in that house. And so upstairs it's a 3-bed, 2-bath, and then downstairs is a studio, ohana, little kitchenette, and as far as we can tell, unpermitted bathroom. And so the way it stood when we last had tenants in there, the upstairs we were renting for $3,400 a month, which is I think a little bit below market rate for a 3-2.
Yeah.
Especially with that kitchen, it's like it's the nicest kitchen under $1 million.
Oh, there you go.
And then downstairs, again, we kind of just did like word of mouth. We didn't advertise it, and we were renting downstairs for like $1,350. So overall, it was $4,750 per month that we were getting in rent from that. And so when we lived in it, sometimes we would have a tenant downstairs. We only ever did long term, and we usually did like people who were like baristas and stuff like that, bartenders. The backbone of Kona.
Yeah.
And they would kind of get a sweetheart deal. We'd do like $1,300, like including every like Wi-Fi and everything else. But it offset our mortgage payment by that much every month. And then I also wanted to talk about we closed on that in early 2020, like right as the pandemic was. Like we literally closed on like April 1st or something of 2020. So we went on when we opened escrow, it was like the Tokyo Olympics were still scheduled, and then by the time we closed, it was like the NBA was playing in a bubble, and it was really weird, and we were like, should we be doing this? So that was a different time. So I wanted to talk about like a current, more recent example, and so this is a transaction that I did earlier this year. These folks got a 7% interest rate. They had help from family, and that's how a lot of this is getting done. Is like you kind of have to have a little hooey to sometimes to make it happen, or some people do. This is a young couple with no kids, so this is like the quintessential house hack. So they figured out their budget. They got with me. They applied. I got them pre-approved. Talked to all the family members. We had some gift money coming in. We had some co-signing happening. Yeah. And so, but we all knew the plan. The plan was, let's find a house that has an ohana or some other ADU, and then the buyers are going to live in that, and they're going to rent out the main house, and that's the plan. And so,
and this could be your plan too.
This could be your plan. And so, just to kind of break down some of the numbers, the house was just under $1 million. This was a 10% down purchase. So primary residence, 10% down. Their interest rate at the time was about 7%, 6.99. This was earlier this year. And so the total, including everything, mortgage insurance, property taxes, which the property taxes are higher than they're going to be because this was not a primary residence at the time they bought it. So their taxes are going to actually go down. But with everything all in, taxes, insurance, and mortgage insurance, their total payment was just over $6,500 a month. Okay? It's a lot of money. But they moved into the ADU and immediately rented out the main house for, I think, $4,000 or $4,100 a month.
Which is about what whole houses are starting to go for.
Right.
Yeah.
And so they, so now basically their shelter cost is about $2,500 a month.
Which is like, that's doable.
Which, yeah, I mean, they could go out and maybe get a 2-bedroom condo somewhere for that. Maybe. $2,500. I don't know. They could definitely get a 1-bedroom. Okay. I looked on. So I before I came over here, I hopped on Zillow and checked on like houses for rent. I was seeing studios for $1,975. Yeah. I was seeing 1-bedrooms for $2,600 and 2-bedrooms for $3,000 and more. And so these guys are living on their own property in their own
gaining
ADU, gaining equity, paying down their mortgage. Well, actually, having somebody else is paying down their mortgage. Yeah. Right. Their mortgage interest that they're paying is going to be, on that big of a loan, $900,000 at 7%. Their mortgage interest deduction is going to exceed the standard deduction. Yeah. I'm sure. Yeah. So it's going to reduce their taxable income. And they get to, they'll report the income on their Schedule E, and they get to depreciate that as well. So they'll put their rents received, and then they get to, they'll take out the, the interest, the insurance, the HOA, the maintenance, the repairs, anything else.
Write all that off.
Yep, and they take it right out and reduce. But they're making that income, call it $50,000 a year. And they're going to be able to write most of that. This is not tax advice, but they're going to be able to deduct most of that from their Schedule E rental property income from their own primary residence, while still living on the property as their primary residence. It's just a great setup. And
you know what the best thing about that whole thing is? They get to live in Hawaii.
They get to live in Kona. They get to live in Kona.
$2,500.
And so, here's the thing: I'm watching rates go down. When the time's right, I'm gonna hit them up and say, let's refi for free, right? We're gonna absorb the closing costs, or the lender fees, not all closing costs, but we're gonna waive the lender fees, and we'll refinance them when we can at the 5.99. We'll drop their payment by a full percentage point. Their taxes are going to go down next year when their homeowner exemption kicks in,
right?
And then they're going to be looking at a payment under $6,000 instead of $6,500. They'll be paying $5,700 or $5,800, something like that.
So then their price goes down to $2,000 a month to live there.
Yes.
Okay.
Yep. So we're going to help them whittle that down over and over. But the point is that it worked at the time. It even made sense at 7% for them. That's the important thing. We didn't have hope as a strategy.
Yes, no, hope doesn't work. Also, I like the fact that you went through all the little things, because it's important for people to see the tax write-offs and how you can use depreciation, because basically it's a working asset.
Yeah.
Right. So these are all and again, like you say, it's not a tax accountant, but that gives you some ideas, so you can actually talk to a tax accountant. It's not financial advice. I'm not an accountant. Right. And that's the reason why this is a private group too. So
exactly.
We're kicking our asses out there and calling the cops.
Yeah, exactly. Calling the cops.
The interesting thing too is that and we keep talking about this, you guys, there is many homes, stadium seating, that have these undercarriages of condos, or what's it called, ohanas.
Yeah.
And some of them have no. But the thing is that if you guys want to get those properties as they come on the market, as soon as they come on the market, because Eric and I get these preview statuses too, drop an email to us, and we'll make sure that you get a chance to get those homes as soon as they come on the market, delivered right to your inbox, so you guys can see what's available out there. I have been dropping some examples of what's on the market inside this group, so people can see what's out there. But it does seem that things are kind of shaking up. There was 14 homes on the caravan today.
Yes.
So inventory is coming back on the market.
Yes.
And so if you guys think this is a good opportunity, and we keep talking about this, and even if you guys want, reach out to Travis to figure out what you can qualify for, and get kind of creative with canoodling ideas on what could work. That if you did find a 1.3 come up that has a solid income underneath it, and I just saw another house for $975 that had a studio. Mm-hmm. So this $975 with the studio thing is not rare either.
No, mine's $925 with the studio,
and it's for sale right now.
Yep, with a $20K buyer credit.
There you go. So did you hear that? So if you guys are thinking, you don't know the MLS number, do you?
No.
Okay, I'll drop that below if you guys want to do it. But there you go. There's right there. Boom.
Right.
Also, we're working with a young couple that maybe would sell their house for $925, but they're trying to get into something that's commercial, and I think it's a little harder than they thought. So they might be hanging a little bit longer.
Yeah.
But I'd love to be able to give you guys the deals and steals as soon as I see them.
There's the one $875.
$875.
There's one for $875.
Really? Does it have a something like a unit, like a?
I want to say it might be a 2 up and a 2 down.
Oh.
But I think it's Gretchen's.
Oh. Well, I know for a fact there's one in Pula on the Estates that's been sitting there for a very long time. Actually, the reason why it's not selling, it doesn't have a great view. Oh. But it has a nice separate ohana underneath the house. And so I know they're ripe for a price cut.
Yeah.
So, and that's another thing too, you guys. That's what's great about this market right now, is that you can negotiate.
Yeah.
I think negotiations are all about what's happening right now in this market. So we've been talking about the fact that if it's been on the market for more than 3 weeks, it's time to talk.
Yep.
Right?
Yep.
So there's opportunities. So, Eric, is there even
No question.
But no, because we want to take questions too if you guys had any. And if you guys have questions about anything to do with mortgages or finances or whatever, and I can tell you a little bit more about maybe like, you know, some things that you have to think about when you buy a condo, like getting a renter. We're going to talk about that in our next episode. In fact, I might even like invite Kyle or Blake in.
For property management. Oh my gosh.
To talk about some of the stuff that you need to do if you're going to property manage on your own.
Yes.
So stay tuned for that. But we are going to offer you guys some more advice next time we come together. We'll do it a month. We're trying to do this on the third Thursday at 3 o'clock every month. And for all of you guys watching this in replay, again, reach out if you need extra advice from either real estate or mortgage. And also title and escrow. This guy knows a lot about that stuff too, in case you want to talk about HARPTA or FERPTA or FERPTA or wherever else.
FERPTA is fun to say.
Yeah. So thanks again also for Eric, our cameraman, for keeping us on track. Eric. And if they want to get a hold of you, your email real quick.
Email is tgreen, TGREEN @guildmortgage.net.
There you go. And Eric and I are going to be releasing a new website at 365HawaiiRE.com. And so we're going to put actually the transcripts of what we're going to be talking about on that website pretty quick.
Awesome.
And then it'll be a nice little summary and everything else. So we're still growing this thing. You guys, we appreciate the people that have joined in first. So with that, we will say aloha.
Ahui ho.